Welcome to our educational series on modern money mechanics. Today we'll delve into the intricacies of how money works in today's economy, how you can master its mechanics, and provide you with resources to deepen your understanding. Whether you're an individual looking to manage your finances better or an aspiring economist, this video is for you. Watch until the end to grow your understanding. These concepts can empower you to make informed financial decisions, improve your personal financial health, and stay ahead in a constantly changing economic landscape. Understanding modern money mechanics. Modern money mechanics refer to the systems and processes through which money is created, distributed, and managed in contemporary economies. It includes understanding how central banks operate, the role of commercial banks, and the impact of fiscal and monetary policies. The role of central banks. Central banks, such as the Federal Reserve in the United States or the European Central Bank in the Eurozone, play a crucial role in managing a country's money supply and interest rates. They implement monetary policies to control inflation, manage employment levels, and ensure economic stability. Key functions: issuing currency. Central banks are responsible for issuing national currency. For example, the Federal Reserve issues the US dollar. Regulating banks. They supervise and regulate commercial banks to ensure financial stability. The Federal Reserve, for instance, sets reserve requirements for banks. Monetary policy. They set interest rates and use other tools to control money supply. For example, the Federal Reserve might lower interest rates to stimulate borrowing and spending during an economic downturn. Relevance to the viewer. Understanding how central banks influence the economy can help you anticipate changes in interest rates that could affect your loans and savings. For example, if you know that the Federal Reserve is likely to increase interest rates, you might decide to lock in a fixed-rate mortgage before rates rise. Commercial banks and money creation. Commercial banks create money through the process of lending. When banks provide loans, they create new deposits in the borrower's bank account, effectively increasing the money supply. Fractional reserve banking. Banks are only required to keep a fraction of deposits as reserves and can lend out the rest, which amplifies the money creation process. For example, if the reserve requirement is 10%, a bank can lend out $90 for every $100 deposited. Relevance to the viewer. Understanding how banks create money can help you see the bigger picture of how your savings and loans fit into the overall economy. This can influence your decisions about saving, borrowing, and investing. Fiscal policy involves government spending and taxation decisions. Governments can influence the economy by adjusting spending levels and tax rates to either stimulate or cool down economic activity. For instance, during a recession, a government might increase spending on infrastructure projects to create jobs and stimulate demand. Conversely, during periods of high inflation, it might reduce spending or increase taxes to cool down the economy. Knowing about fiscal policy helps you understand how government actions might impact your job prospects, tax rates, and overall economic conditions. For example, if the government announces a large infrastructure project, you might expect more job opportunities in construction and related industries. Key concepts in modern money mechanics. Inflation and deflation are crucial concepts to grasp. Inflation is a general increase in prices and fall in the purchasing value of money. It is often controlled through monetary policy tools like interest rates. For example, if inflation is rising rapidly, the central bank might increase interest rates to cool down the economy. On the other hand, deflation is a decrease in the general price level of goods and services. This can lead to reduced consumer spending and an economic slowdown. A historical example is the deflation experienced during the Great Depression. Understanding inflation and deflation can help you make better financial decisions. For instance, during times of high inflation, investing in assets that typically outpace inflation, like real estate or certain stocks, can help preserve your wealth. Interest rates are the cost of borrowing money. Central banks manipulate these rates to influence economic activity. Lower rates encourage borrowing and spending, while higher rates aim to control inflation. For example, if you have a variable rate mortgage, your monthly payments might decrease if the central bank lowers interest rates. Conversely, if rates rise, your payments could increase. Keeping an eye on interest rate trends can help you decide the best times to borrow or save money. For instance, you might choose to refinance your mortgage when interest rates are low. Quantitative easing. A non-traditional monetary policy used by central banks to stimulate the economy by buying government securities or other securities from the market to increase money supply and encourage lending and investment. For example, during the 2008 financial crisis, the Federal Reserve used quantitative easing to inject liquidity into the economy and stabilize financial markets. Understanding quantitative easing can help you anticipate changes in the economic environment and adjust your investment strategies accordingly. For example, you might expect stock prices to rise during periods of quantitative easing. Mastering personal finance. Budgeting and saving are foundational to financial health. Creating a budget helps track income and expenses, ensuring you live within your means and save for future goals. Tools like apps Mint or YNAB, which stands for You Need a Budget, can assist in creating and maintaining budgets. For instance, Mint helps you track your spending, categorize expenses, and set budget goals. On the other hand, YNAB focuses on giving every dollar a job and encourages proactive financial management. By budgeting effectively, you can avoid debt, save for major purchases, and achieve financial stability. For example, having a solid budget can help you build an emergency fund, reducing stress during financial emergencies. Investing helps grow your wealth over time. Understanding different investment vehicles like stocks, bonds, and real estate is crucial. Diversification is key. Spread investments across various assets to minimize risk. For example, if you invest in both stocks and bonds, a downturn in the stock market might be offset by gains in the bond market. Investing early to take advantage of compound interest is also essential. For instance, investing $1,000 at an annual return of 7% can grow to $7,612 in 30 years due to compounding. Investing wisely can help you achieve long-term financial goals like retirement, buying a home, or funding education. Understanding investment basics enables you to make informed decisions and maximize returns. Effective debt management is crucial for financial health. Prioritize paying off high-interest debt and understand the terms of your loans. For example, the snowball method involves paying off the smallest debts first to build momentum. Alternatively, the avalanche method focuses on paying off the highest interest debt first to save money on interest. Managing debt effectively can improve your credit score, reduce financial stress, and free up resources for saving and investing. For example, paying off a high-interest credit card debt can save you hundreds or even thousands of dollars in interest. Mastering modern money mechanics involves understanding the roles of central and commercial banks, the impact of fiscal and monetary policies, and effectively managing your personal finances. By educating yourself and utilizing available resources, you can navigate the complexities of the financial world and achieve your financial goals. Remember to like, subscribe, and share. For more educational content and updates, hit the subscribe button and turn on notifications. If you have any questions or topics you'd like us to cover, leave a comment below. Thanks for watching. Additional resources include Khan Academy's Economics and Finance, Coursera's courses on finance, and books like The Creature from Jekyll Island by G. Edward Griffin and Principles of Economics by N. Gregory Mankiw. By following these guidelines and utilizing these resources, you'll be well on your way to mastering modern money mechanics. Thanks for watching.